Here's the part nobody wants to say out loud. SpaceX IPO of the decade isn't generous for letting ordinary people in. It's generous because it needs you. On the surface, SpaceX opening its doors to retail investors looks like democratization. But the real question isn't whether you get a seat at the table. It's whether your seat has a vote that counts. Public filings show a dual-class structure where one founder keeps control no matter how many shares the rest of you buy. Capital never sleeps, and it just changed the rules of the game. Let me show you who's actually holding the bag. What if I told you the biggest IPO ever recorded is reportedly throwing its doors wide open to small investors, handing them roughly 3 times the usual seat at the table, and that this is exactly the part you should be most suspicious of? Most people hear generous to the little guy and feel warm inside. I want you to feel the opposite, because here's my one cold conclusion up front. When the largest deal of the decade suddenly gets generous with retail investors, generosity is almost never the point. The real question is not how do I get in? The real question is why do they suddenly want me in at all? Insider perspective, God's eye view, the way I'd have read this back when I sat in an analyst seat. Let's break it down. Start with what's on the record. SpaceX was founded in 2002 by Elon Musk, and per public reporting, it stayed completely private for about 24 years. No public shareholders. Just Musk, a fleet of rockets, and a very short guest list: billionaires, sovereign wealth funds, venture capitalists. And the business has been loud. According to the figures in the source material, and I want you to verify these against the actual S1 before treating them as gospel, SpaceX reported around $18.7 billion in revenue in 2025. Then another $4.7 billion in just the first 3 months of 2026. A big chunk of that engine is Starlink, the satellite internet arm. The source pegs it at about 9.2 million subscribers by the end of 2025, and roughly $10 billion in revenue on its own. Then the headline. Per the source, on May 20, 2026, SpaceX filed its prospectus with the SEC under the ticker SPCX, listing on NASDAQ, with trading potentially starting as early as June 12. They ask up to $75 billion, at a valuation around $1.75 trillion. Put that in human terms. That's a single company priced at roughly the scale of an entire mid-sized national economy. Monster company. Monster valuation. Doors swinging open. That's the surface. Now let's get to the part nobody puts in the thumbnail. The story you're supposed to swallow is simple and warm. They're being generous. Up to 30% of issued shares reportedly set aside for retail, described in the source as about 3 times a typical allocation. Democratization of the rocket dream. Come grab your piece of Mars. Don't kid yourself. It's not that romantic. Do the math. If you're raising $75 billion, the hedge funds, the sovereign wealth funds, the institutional buyers could absorb this whole thing on a quiet Tuesday afternoon. They've been doing exactly that, privately, for over 2 decades. On the numbers, SpaceX does not need your money to fund the business. So what's the 30% for? Here I have to be precise, because this next part is the source's interpretation, not a proven fact. The argument goes like this. Retail investors aren't really buyers in this story, they're insurance. When millions of regular people own a piece of something, they talk about it, they defend it online, and crucially, they tend to hold on even after the early insiders have quietly started heading for the exits. On the surface, it looks like access. Read it as a different word. Support. 4 characters share one very cramped office cubicle. And they do not want the same thing. 1. Elon Musk, founder, face, and as we'll see, the controlling vote. 2. The early insiders, the VCs, billionaires, and sovereign funds who got in low and private over 24 years. 3. The exchange itself, NASDAQ, which is supposed to be a neutral rulebook. And 4. You, the retail investor, or the index fund holder who doesn't even know they're about to be in the room. 4 players, wildly different cost bases, wildly different power. Hold that asymmetry in your head, because every layer below is just that same asymmetry told in a different language. Follow the money and the generous allocation starts to look like something else. The early money came in low over many years at private valuations that were a fraction of $1.75 trillion. The new money, retail, and as we'll get to, passive funds, comes in at the top. Peak hype, IPO price. That's the whole shape of the trade. Early in low, late in high. We've seen this episode before, and I'll be careful. The comparison comes from the source, not from me calling an outcome. The reference is Saudi Aramco's 2019 to 2020 listing, at the time also billed as the biggest IPO in history. Institutions priced the deal near the top. Many retail buyers who chased the hype watched the stock trade below its IPO price for a stretch, while the funds and insiders had entered lower. History doesn't repeat, but it rhymes often enough that you should at least notice the melody. So, the question isn't, is this a once-in-a-lifetime opportunity? The real question is, in this exact flow of money, who's the buyer of last resort, and who's the seller of first opportunity? When you buy shares, the classic deal is two things: a slice of the upside and a say in how the company is run. SpaceX will absolutely give you the vote. The problem is what the vote can actually do. This runs on a dual-class share structure, two classes of stock, different voting power per share. And let me be fair here, because this matters. It's common, and it's not inherently sinister. Alphabet has one, Meta has one, Snap has one. It exists so founders can raise money without Wall Street hijacking their long-term vision or, in extreme cases, shoving them out of the company they built. But according to the S1 cited in the source, SpaceX takes it to an extreme. Musk reportedly controls almost 80% of the votes while holding about 42% of the equity. His shares simply carry more weight than yours. And here's the line that matters most. The filing reportedly states Musk keeps no less than 25% voting control under any circumstance. Say that slowly. Under any circumstance. No matter how many retail investors pile in, no matter how popular the stock gets. The math is built so the founder calls the shots structurally, not just for now. So yes, you get a vote. On the surface, it's shareholder democracy. In practice, on the big decisions, it's a comment box. And to be clean about my labels, the existence of the dual-class structure is a public disclosure if it's in the S1. The framing that it's designed to make your vote irrelevant forever is interpretation. Both can be true at once. Now the part that's easy to miss, SpaceX isn't really one company. It's several businesses wearing one trench coat. The rocket business, Starlink, a growing defense and government contracts arm. And tucked in the back, an AI operation. For the source, in early February of this year, SpaceX acquired Xi, folding rockets, satellites, connectivity, and AI infrastructure into the same corporate body. Sounds futuristic. Then you open Xi's books and it's a sea of red. The source reports a loss of $6.4 billion last year. So how does a company bleeding that much keep the lights on? The source says Xi is being propped up by SpaceX's profitable launch revenue and Starlink subscriptions. Here's the translation. If those numbers hold up against the filing, then buying into SpaceX doesn't just buy you the profitable headline-friendly parts. You're also buying a slice of a business burning cash fast, cross-subsidized by the parts that actually make money. That's a risk transfer hiding inside a merger. And it gets sharper. The source reports that weeks before Xi was absorbed, Tesla put roughly $2 billion into Xi. According to the source, Tesla shareholders voted against it. The plan was formally rejected under Tesla's own process, and it proceeded anyway. I'm going to flag this hard. This specific sequence is the source's claim. It's exactly the kind of governance assertion you should confirm against Tesla's official filings and proxy disclosures before repeating it as settled fact. But if it's accurate, the implication is brutal. When SpaceX swallowed Xi, Tesla's Xi stake reportedly converted into SpaceX stock, meaning a Tesla shareholder could have woken up as a part owner of a private rocket and AI conglomerate before the IPO even launched through a move their own vote opposed. Which raises the uncomfortable question, if a Tesla shareholder vote couldn't stop that, what exactly protects a SpaceX retail vote later? This is the layer almost nobody talks about, and it's the most important one. When a company lists on NASDAQ, it automatically joins the NASDAQ Composite, an index that tracks basically everything on the exchange. Above that sits the NASDAQ 100, the top tier by market cap. That's where the real gravity is. Per the source, the NASDAQ 100 is tracked by over 200 investment products, including QQQ, one of the largest ETFs on Earth, with $600 billion+ in assets. Here's the mechanic that matters. Funds tracking an index don't get to have opinions. When a stock joins the index, those funds are required to buy it. Not encouraged. Required. Historically, there was a break on this. A company normally had to wait around 3 months after listing before it could even be considered for the NASDAQ 100. That seasoning period exists for a reason. It gives the market time to price a company on fundamentals separate from launch day hype and founder mythology. But per NASDAQ's own rule change, effective May 1, 2026, it introduced fast entry requirements. A company can now join the NASDAQ 100 within just 15 trading days after IPO, down from at least 3 months. The source frames this as the exchange bending its own rules because NASDAQ and the NUMURS were competing to win the listing. Let me mark that clearly. public. The timeline and the rule change, if accurately reported, are public-facing facts you can check yourself. The motive, that they did it because SpaceX asked nicely, is interpretation, not a documented fact. But watch what the rule does regardless of motive. Put it together. SpaceX lists. It automatically enters the composite, and under fast entry, it could be eligible for the NASDAQ 100 in roughly 3 weeks. The moment it's added, every passive fund tracking that index, including the one sitting inside countless 401ks, IRAs, and pension allocations, is mechanically obligated to buy it. Think of an index fund like a set menu. You did not order each dish, you just said yes to the menu. And now the kitchen has quietly added a new dish at peak hype pricing, and you're paying for it whether you asked or not. Millions of people who never read the prospectus, never thought about dual-class shares, never heard the word XI losses, could end up owning SpaceX at the most expensive moment in its public life. Automatically. Let's name it plainly using the asymmetry we set up at the start. Who got in low? The early insiders, the VCs, the sovereign funds across 2 private decades. Who has the upside and the control? The founder, with reported roughly 80% voting power and a structural floor that, per the filing, never drops below 25%. Who comes in high? Retail buyers at IPO price, and passive funds forced in by index inclusion. And who carries the cross-subsidized cash burn of a loss-making AI arm? Everyone holding the combined stock. That's not a conspiracy, it's a structure. And here's the thing about structures. They don't need bad intentions to produce lopsided outcomes. They just need rules that route the upside one way and the risk the other. Here's the layer you're most likely to misread. It's not the valuation. Everyone argues about whether 1.75 trillion is too rich. That's the obvious fight, and honestly, it's the least useful one. The layer that actually decides who wins is the rulebook. The voting structure, the index inclusion mechanics, the cross-subsidy buried inside the corporate body. These aren't headline numbers. They're plumbing. And the plumbing decides whether your money has a say or just a seat. And don't over-attribute everything to capital either. Part of this is genuine investor enthusiasm. Part of it is exchanges competing for a prestige listing. Part of it is the founder's real, demonstrated ability to build hard things that fly. The point isn't that someone is evil. The point is that when control, cash flow, and risk get split this unevenly, you want to know which side of the split you're standing on before you commit a single dollar. And let me be honest about what I don't know. Several of the most dramatic beats here, the Tesla vote sequence, the motive behind NASDAQ's rule change, the insurance framing come from a single stylized source. Treat the revenue figures, the dual-class structure, the fast entry rule, and the XI loss as items to confirm against the actual S1 and official filings. Not my verdict. Your homework. So the next time a once-in-a-lifetime deal swings its doors open and tells you it's doing it for the little guy, slow down. Don't rush to take a side. Ask the only 3 questions that ever matter. Who's making the money? Who's controlling the game? Who's left holding the risk? And then check who gets paid first. If you want to keep seeing the capital logic behind the headlines, the part that doesn't fit on a thumbnail, subscribe, because capital never sleeps, and neither does the rulebook. See you in the next one.